The pound sterling has slid following a shock decision by the Bank of England to leave interest rates unchanged. Despite heavy hints and much speculation in recent weeks that rates would rise to 0.25%, they will remain at the current rock bottom 0.1%. Just 2 members of the 9-person Monetary Policy Committee voted to increase rates: Deputy Governor Sir Dave Ramsden and external member Michael Saunders. The bank's reports also showed they expect inflation to peak at 5% next year. Tim Bannister, Rightmove's director of property data, commented, "Although interest rates are staying at 0.1% for now, the expectation that they're going to slowly start to rise may lead to some buyers accelerating their plans to move and secure a fixed-term mortgage deal now, due to a fear of missing out on the historically low rates that were on offer. If interest rates do rise in the coming months, as expected, their effect on house prices in the short term may be muted by the ongoing high levels of demand we are seeing and the fact that interest rates will likely still be at levels well below historic norms. Buyers who are already facing stretched affordability due to record house prices would find it slightly more expensive to borrow if rates rise in the coming months." In the rental market, some landlords who are not on fixed-term deals may be tempted to pass on any increase to interest rates to their tenants by raising rents a little when contracts are up for renewal. However, the value of a good long-term tenant should not be underestimated heading into the winter months. While demand for rental property remains extremely high, there are signs of more stock starting to come back onto the market, meaning tenants will have more choice after the fierce competition we saw throughout the summer. Taking to Twitter, financial expert Martin Lewis commented, "It seems the markets and the public view was not upheld by the Bank of England's rattlesnakes. Many happy mortgage holders out there, many gutted savers. Despite interest rates holding for now with predictions of inflation set to rise well beyond target, there are still warnings a further rate rise could come." Hussein Mehdi, macro and investment strategist, HSBC Asset Management, said, "Nevertheless, a further increase in inflation in the coming months on the back of higher energy prices and the risk of rising wages will maintain pressure on the MPC to act. A rate hike at the December meeting is possible, but with price pressures set to ease next year as supply-demand imbalances work themselves out, market expectations of a series of rate increases in 2022 look too aggressive to us." Indeed, the bank's latest forecasts, which incorporate this market pricing, now show inflation falling below target by the end of its forecast horizon. Overall, this could still end up being the most dovish hiking cycle on record. The announcement comes as a slight surprise given heavy hinting from Bank of England members about a potential rate hike. Governor Andrew Bailey previously said the bank would have to act on inflation, whilst Chief Economist Hugh Pill told the Financial Times discussions would be live. Melissa Davis, chief economist at Redburn, commented the results was a bit embarrassing given the confused nature of communication in recent weeks. The Confederation of British Industry struck a more positive note, however. Alpesh Palija, CBI-led economist, said, "On balance, the decision to keep interest rates unchanged is the right one. The upcoming rise in inflation will likely prove transitory, and there is as yet only patchy evidence of rising prices becoming embedded in both wage setting and households' inflation expectations."